Hi everyone, and welcome to tonight's weekly webinar. Tonight is a bit of a special event. We're doing a post-election webinar tonight, and we're joined by Chris Weston, which is he's head of research at Pepperstone. So he's going to give us a different insight onto what we're looking at after the election, and we're going to talk about the things that we were actually expecting to happen, what did happen, and how the markets are going to react to potentially a pretty tumultuous time. With the next 90 days is going to be a certainly interesting play in the US, and it's going to affect the world market. So yeah, we'll jump straight in, and I'll just introduce Chris. So Chris, do you want to say hello to everyone? And
yeah, it's great to be here, filling in for some big shoes with Thomas. Yeah, no, it's good. I mean, I think it's been an exciting couple of weeks, and I think a lot of people are pretty glad that we've got the election out of the way. I don't think it's the end of it by any means, and we're looking forward to 2021, which I think the market's already starting to price that in, which I think is really, really interesting. We can talk about that in a minute. But yeah, no, fascinating, times in the markets. And yeah, obviously great to be here. So yeah, how did you go over the election? Did you, what were you looking at, and how did it fare for you guys?
we actually did a lot of looking. Like leading into the election, we certainly did plenty of trading in the weeks leading up to it, because the volatility was great, and the market, for all intents and purposes, I think from a technical standpoint, it was behaving itself a little bit, and
Right.
I think it probably behaved itself a little bit more than I thought it would, given that the results were pretty, like it was very up and down for a long time. Like even after the election day, like it was swings and roundabouts as to who was going to win and how it was going to work out. And I think, given all of that uncertainty, the market seemed to have really behaved itself. And I was actually surprised by that. We chose not to actually trade for that week because we were just waiting for that big giant move either way. And I think it probably didn't really come until I think the vaccine news probably pushed the market a lot more than anything else, really. But yeah, rightly or wrongly, we chose not to trade it, and we just observed. But I think there were some lessons to be learned there. But the markets have certainly moved up in a pretty positive direction now. And I know you've got quite a bit of analysis there that we can actually talk through, which we don't often cover in our webinar. So it'll be good to get your insight on it.
Yeah, I mean, I just remember I think first things first. If we go to the let's go to the VIX chart, and you can see around the 30th of October, so a few days into the lead up, our VIX price here, which is the implied volatility over the coming 30 days of the S&P. So that got up to 35%. So that's not the cash VIX. That's actually based off the front month futures, which obviously we can hedge out there. But you can see that got into 35%. I think the cash VIX got up to 42%. And I think that implies a sort of a daily move up or down in the S&P of around 2.6, 2.7%. So it was obviously very elevated. I think if you look at the S&P options term premium, it was pretty clear, Tyrone, that the market was hedged for a really bad outcome. They'd been using options to trade big moves down. I think a lot of the big institutional funds, rather than necessarily going to cash over these events, if you're holding a large core position, if you're a pension fund, you see these sort of short-term blips as noise. You sort of take out these sort of consultants who come in and give you some pretty punchy and some very advanced options sort of hedging strategies, mostly using, as I say, options, just to capture any kind of downside moves that you may get, and therefore you don't have to liquidate your core positions. But we could see that the market was hedged for some dire situations. So I think when the market sort of goes, and we might get a split Senate here, and a split Congress, sorry. Then we started seeing a lot of these negative bets, these sort of hedging situations being unwound, and I think that's why we saw such an aggressive move on that day of the election, really, because just so many people have hedged themselves against a disaster situation. I'm not sure how closely you guys at FX Evolution have been looking at implied volatility in the FX market or implied volatility here, but you can see it was pretty elevated. And therefore, people were. You can make obviously an assumption that people were hedging You go to the day though, I think it was really interesting because what we've got on this top pane here is Predict It, which a betting website just looking at the probability of an outcome, which you can trade, and you can see here that the implied probability of Joe Biden winning the election, if we just use that as the presidential situation, was around sort of 64%. We sort of came into here around 62%, and then I can't remember which state it was. I think obviously Trump was looking like he was going to in Florida. He started looking like he was going to do pretty well in Wisconsin, and the implied probability of Trump winning got to about 60-odd%. And some betting sites it got even higher. I think Betfair or one of the sports bets got down to $1.15. And you can see here then by about 9 o'clock at night, everyone was sort of saying, "Oh, Trump's going to win this. Trump's got this in the bag." And we were sort of extrapolating what Wisconsin meant for Michigan and Pennsylvania and some of the other sort of states around there. And everyone was saying, "Oh, Trump's going to get this." I sort of went to bed knackered about 9 o'clock at night, and you can see here the implied probability of Biden winning then suddenly got up to about 90%. I was like, "What's happened here?" And he looked like he rattled back Wisconsin and a couple of other states. And of course, we haven't looked back. And while there's still a few votes to come, it's pretty obvious that Joe Biden's got this. The Senate is still very much up for debate. There's a runoff there which we can talk about, but you can see the swings and roundabouts there. You've got a lot of hedging which has been unwound in the market, which I think has ultimately caused this situation. And then you can see that at one stage we've got Trump was looking like he'd got it, and then it's sort of swung back to Biden, and that's where we are right now through this situation. I really find it quite interesting that you chose to stay out of the election. I think when implied volatility is as high as that you've got to make a decision. Do you want to be involved as a short-term trader, or do you want to be out because this is an outcome which could be very hard to predict? So is that something that you do around a lot of big events? Just taking the view that the outcome's outside of your control, and therefore it's probably just better just to stay out.
Yeah, so generally speaking, the way we like to play it, and this is what we always do when we do our weekly webinars, is we know that there's probably 350 to 360 pretty good days of trading every year. Mm-hmm. So and knowing that what we did, we actually tried to play the last election. So we're probably a little bit not so much scarred from it, but a lot of the short-term trades that we were placing in the initial Trump election 4 years ago, the market was so volatile then that it was actually, spreads were widening, stops were being taken out, prematurely, and the market would swing, and it just caused so much, I guess, not so much stress, but it really upset what we would normally look for in the market. So the reason we chose to stick out of it, now when I say stick out of it, we actually we exited it from a Forex standpoint, but in terms of options, which is a lot of our core work with our clients, the options were running rampant in that time. That we did wind up because the options premiums went through the roof. There was no question about that, and we used that to our advantage. But the great thing about options, and I know we explained this sometimes in the room, is that the risk is actually fixed regardless of how you play it. When you take out an options trade, whether it's a call or a put, the risk is fixed to the amount that you put on, and that no matter what happens to the outcome. Whereas, of course, with Forex, stops can be jumped. We can have big gaps in the market. And although they didn't eventuate, I guess we planned for them. And given that we get, there's not many events that we don't trade. We stick clear of non-farm payrolls about an hour before it happens every month. But aside from that, there's not too many events that we actually stick clear from. So we thought this time, rather than potentially putting ourselves in harm's way, let's watch and observe and see what we can learn from it. So I think that's probably the tack that we actually took. Now, given that, what we did find, and it did set up for this, a lot of the majors that we generally look for, especially in the Forex space, were setting up at really, really strong levels. And I'm sure you've probably noticed that as well, Chris, in your analysis, that we always think, rightly or wrongly, that the market does gravitate to very key zones when there's uncertainty, and it seemed to do that. So what we were hoping for,
I'll bring up a chart. Which currency pair in particular do you want to talk to there?
Yeah, so probably the euro. We can go to the euro USD probably as a starting point. So with the euro USD, we know it's been trading in a range of around 117 to 119. It's been a really good trading range for quite some time now.
Yeah,
And yeah, what we were looking for was, you know, we were looking for breaks of either because a break above 119 was probably going to signal a pretty significant move up, and yeah, a break below the 117, like a serious break, was going to push us down. And our preferred move was probably to go down from the 117 because there was a lot less headwind for it. Like a breakdown below 116, really was an uninterrupted run to about nearly 114, 115. So there was several
yeah,
hundred pips of pretty clear movement, and we do like that.
mm,
That's what when we're looking for a break of a very significant zone, we're always looking for the next resistance or the next support, whatever's going to be in the way. And the downside movement provided, 200 or 300, not easy pips, but what we call, I guess, blue sky, if you like, without a lot of trouble in
mm,
front of it. Now, neither scenario really eventuated and actually stayed in that zone. So,
mm.
like I said, it probably caught us a little bit by surprise because I actually thought that the market would have a different reaction to a Biden win. Um, Longer term, we didn't really have a view as to which one was going to be better for the market. I think both Republicans and Democrats had their positives and negatives for the stock market moving forward. I think
Yeah,
from our standpoint, though, the Democratic win was probably going to be a longer term play for the stock market. So we probably expected it to sell off rather than go up initially, and then maybe
mm.
over time start to pick up. But that probably caught us a little bit by surprise. Did the market movement surprise you, or it just seemed a little bit steady for mine?
Well, I was making a joke with a client that I said, you know what, if we go back to 2016, and if I'd said to you the day before that Donald Trump was going to win the election and we were going to see a Republican sweep, they got the House and obviously the Senate as well. Do you think that you would have made money? Obviously, if you go to the booking, the bookies, then you definitely would have. But he said no. And I was like, I actually completely agree. I mean, I think if in 2016, if you'd gone to bed, if you're a US trader and, the world was going to collapse because Trump was going to start wars and it was going to be such unpredictable policy that everything was going to collapse, you would have gone short the S&P, you would have gone long US treasuries, you would have gone long the yen and Swiss franc and gone to close the screens if you were away from the screens, if you didn't have the luxury of passing it onto your Asian trading desk or European trading desk. Structurally risk averse. And, for about 6 hours or so, you're doing pretty well. And then everything turned. As soon as Donald Trump started speaking, the world changed and we saw one of the biggest reversals and sustained reversals for a long time. And so I think the answer was absolutely no. I mean, I think everyone's got a plan until you get punched in the face, and that would have been the situation there. And I thought about that this time around. I said, well, if we knew the outcome, do you still think you can make money? And I think I think the first thing I looked at was, and I was putting in my daily reports, is that we could get a rally regardless, just because of the level of hedging that comes through. And I think that what actually has transpired is it has been the best case for markets. With Biden in the White House, the perception is we're going to get more or less unorthodox policy settings. He's going to take on. He's still going to be very harsh to China. He's not going to change that. His way of diplomacy is going to change. He's going to be less blunt, less crude, finesse it a little bit, but he's still going to be pretty hard on China. In fact, some capacities like human rights, I think he might actually be harder. But I think what you've also got is, as I say, is you've got more predictable policy. I think he'll work much closely with key trading partners like China, like Canada and Mexico. The UK is a really interesting one. We can talk about the pound in a minute, but obviously that's regard. If they can pull out a Brexit deal, then you'll probably get a free trade agreement with America as well. Biden's obviously claiming his Irish roots, and that makes it very sensitive with the UK. But I think I was also suggesting that you can't put a price on just how important the Congress is as well, because if Biden's going to come in at the White House, having the Republicans in the Senate means that, well, if you were to get a blue wave, which can still happen, we can talk about that. If you were to get a blue wave, then effectively you're going to get concerns from the market that you're going to get high corporate tax rate up to 28%, which will be staggered over time. you were concerned that we were going to get personal tax. So for people earning over 400 grand, we're going to get a much higher tax. So that was going to offset anything to do with the near-term fiscal policy that we're expecting. We're obviously going to see a big impact on what was going to happen with alternative energy. The energy markets, the old school energy markets, were going to get taken down. There was concerns around what was going to happen in tech. So the fact that you've got that split Congress means that you get those checks and balances. The hard left under AOC and Elizabeth Warren, Bernie Sanders say, and they have less of an impact on the private sector. It's not me giving a political view. I haven't absolutely no care who is in, but the fact is, where you've got that. The Republicans in the Senate means that you don't get that left concerning the market. So I think that was the perfect storm. The problem that we've got is that on January the 5th, which is also my birthday, we have Georgia, which has a special election. They've got 2 seats for the Senate. Now, if they both go to the Democrats, then the split in the Senate will be 50-50. And for people who are not so familiar with the US electoral process, in a 50-50 split in the Senate, the last decision on big calls going forward on policies on federal changes with legislation will go down to the vice president. Of course, that's Kamala Harris. So in that situation, you get a blue wave. So we're all looking for this special election in Georgia now, where you've got these 2 seats, these 2 different electoral situations. And if they both go to the Democrats, then you will get a blue wave. So it's not settled yet. And that will mean you're going to get another leg lower in the dollar, because you're probably likely to see a significant green energy bill coming through of about $2 trillion, which will increase the deficits. I'm talking fundamentals here, but that could still happen. My view is the large consensus is that both those seats will go to the Republicans. Georgia as a state has been traditionally very Republican. It was only, we saw Biden winning that state, but it was the first time since 1992, and they flipped the House as well. But the betting markets are suggesting that the Republicans are going to win this, and therefore you get this perfect storm in the market's eyes in terms of the election, which is why we are where we are. But they're still possible. You're getting celebrities going down there now, starting to campaign in Georgia. You've got, key really big celebrities within the big hitters from the Republican Party or the Democrat Party coming down to Georgia and going, come on, rouse the troops, let's get a blue wave coming through. So we've had the election, but it's not over. And that's why we've got to look at this Georgia race, because if both those seats go to the Democrats, then we will get this so-called blue wave where the Democrats get all 3 chambers and the hard left will have more of a say. And that could be a volatility event for markets. So we're looking for January the 5th. This election is not over at this point. But we do expect both those seats to go to Republicans. But as we know, polls and betting markets have not got this overly brilliant. So, I do think we need to have a look at the dollar on the back of that, because if we get that Georgia seat going to both those houses, then the Senate, the Democrats will get a clean sweep here. And it sort of feeds into my macro view. I mean, I'm not sure how you guys look at much bigger picture stuff, but I tend to have a look at, this sort of the big picture situation and then work in. And I know a lot of people in this room will look at monthly charts, but sometimes I do, and it gives me an incredible oversight of how things are going. And if I look at the dollar structure, and I don't know if you can talk to this as well, Tyrone, but if I have a look at the dollar index, and I know that's heavily weighted towards the euro, 57% of that basket is euro dollar. I see a situation right now where I'm fairly neutral on the dollar. We've still got it pushing higher in this kind of bullish channel. It's consolidating here, but for me, I'm quite neutral on the dollar if I take the big picture stance and what's going on further. And my playbook very much is if it breaks and closes on a monthly basis through this uptrend, then that will certainly get my attention. If we can go through these lows here around 91.73, then I'll turn more bearish, and that will probably coincide with further evidence that Democrats will win that, because I think if the Democrats are going to get the blue wave, then that will be a significant dollar bearish situation. And then I think you've obviously got this significant double top here. So you've got the neckline down at 88, and the technical target, if that comes through, comes down, all the way down into 74. And in that case, I'm going to be looking for, as a sort of tactical play, I'll be very, very short the dollar in my face, and I'll be trading, obviously taking that time frame down and trading out of those dollar pairs. That means a higher euro dollar. It probably means emerging market currencies will do pretty well. I'd imagine gold will probably do well. So I've got my playbook from a big picture stance. I mean, Well, what do you think of that? Is that just too big is that too big a time frame for you guys to work on, or do you agree with that methodology?
Yeah, when we do our top-down analysis, we definitely start out on the monthlies, but we don't often look at those every single week. So we've got our lines pretty much drawn very similar to what you've got there. What we've definitely been playing we've been playing the dollar index for quite some time now. It's probably the last few months in particular, even in the Friday wrap videos that we do, the dollar is always front and center because it's provided.
Yeah.
For all intents and purposes, a very, very good trading opportunity at a very, very key level. Now, it's been this zone between, and although I know we've got a monthly chart here, which is great because it really probably highlights the importance of this zone, I think. And although like sometimes people get a little bit caught up on the number, like it's 93 or it's 92.50 or it's 91, like we consider that, especially on a monthly chart, that's a zone. And inside that zone, even though it's been consolidating here for several months now, it's provided an amazing amount of trading opportunities if you're following price action alone. And
Sure.
and I agree with you. If it does break one of these key zones, good and proper, and by that, and this is probably where we like to say, people get a little bit confused, Chris. We find people get a little bit confused when they say, is a zone broken? Like they might look at your lines there and they say, okay, if that 91.70 gets a 1 hour candle close below it, it's got to be short. Like nothing could be further from the truth. Like that's a zone, and in order for this level to be broken, we would want to be seeing a monthly candle or a weekly candle close actually below that level. And if that does happen, I agree. I think it really exposes the short side of the dollar index, and even a lot of the majors that are actually linked directly to this are a little bit the same way, because I mean that would signal a pretty significant move up in the Euro USD. And a break above 120 and the solid break above 120 really exposes a lot of blue sky. And although it had a lot of support coming down, if we can go to a Euro USD monthly chart.
Yep. I just want to jump in. I've just got a question there from Naran. What indicators are we using here? I'm just moving average, obviously line there, but I've actually got the I high low middle, which is actually one I downloaded. It doesn't come on the MT4 platform. It's one I just downloaded from the web and added to my chart. So all this does is it just takes, so I can choose what high. I've got a 40-day period there, and it just takes the last 40-day high and projects it onto there, and you've got 40-day low, and then you've just got the middle point there as well. So that's the indicator I'm using on that, just to answer that question there. Sorry, Tyrone, if you want to keep going.
Yeah, cool. So obviously, the Euro USD is basically a direct inverse of what the dollar index is doing, given it's so heavily weighted by it. But a break below that key level on the dollar index would see most definitely a Euro USD higher than 120, and that's going to mean it's going to break this pretty significant channel that you can see here that's been in play for like quite a while. This is a pretty significant long-term chart. So really, which one do you play? Do we want a Euro USD going back into the 125s? Like it's possible, and if that dollar index fails to hold at this support, and it's a very, very key support, that's why I've been saying for quite some time this level is really, really important, and it's going to provide hopefully for a little bit more time into the future some really good trading opportunities on the shorter time frames. And when I say short, I'm talking about even 4 hour and dailies, because when you're using a monthly as a support level, even a daily is a short-term time frame. So a series of lower highs and lower lows, and you can see that playing out there. Like you've had, we're very big on price action, as you're probably aware, Chris, and a lot of our followers in here know what we're talking about when we're talking about a series of lower highs and lower lows. And you can see how many trading opportunities this has given us, especially off that base. So the Euro USD has been a fantastic trading instrument for us in this zone, and we're a little bit reluctant. Look, we do take the longer term view, no question. Like we do have a bias for the longer term, but while we see it trading inside the ranges, and even though they are quite a significant range, we trade that and use that to our advantage. So what we're looking for is basically isolating the highs and the lows of the recent movement and trading into that direction. And we're not going to take the bigger longer term view, even though whether it breaks lower or higher for us is probably irrelevant, because we're going to let price action dictate to us which way we're going to follow. But
Mm.
what it does provide, I think, from a personal standpoint, is really good trading opportunities until that actually happens. And I think even when you've got a longer term view, like you said, it gives you plenty of trading opportunities inside that channel
Yep.
by using this price action to tell you when the higher highs and higher lows are actually showing those medium to shorter term trends.
Yeah, I guess the other thing is as well is Trump's not going away anytime soon. He's going to be stuck in that position, and Mitch McConnell supporting his right to do so. AG Barr's indicating that he's looking into irregularities. So I think Trump's going to be in the White House for a number of going to be 20 odd days or so. I think he'll go then, and the chance of him starting his own political party, I think, is going to be pretty high. So watch this space. Trump is not going away anytime soon, and that's going to have big implications. But I also want to say. I agree. I think this chart here is: do you trade dollar index? You trade euro dollar. People will always trade euro dollar because the spreads are much tighter than dollar index. It's the simple way of looking at that situation. But yeah, I think if you get a break of 120, watch the ECB start talking it down, especially Philip Lane, the economist, their chief economist. But yeah, I mean, you've got to respect that, and if it breaks out there, that is definitely one for your radar. I want to talk about the world now, because not only have you got this, but now you've got Pfizer coming out and saying, and yeah, I'll talk about the Aussie dollar in a moment, Tim, and just Kelvin, just in terms of the probability, you can actually just go to Predict It. It's a website, and you can punt on political outcomes, sporting outcomes, whatever you want to do there. So it's just predictit.com, and you can see that. But we'll talk on the Aussie dollar in a second. Now we've got the election. Providing that we do get this Republican Senate, and that's something we do need to consider. But now we've got this additional situation. I want to touch on what the market's also telling me about 2021, because I think this is the big story now. The election is just a bit of a blip, but I think the story that I'm hearing from the markets is absolutely fascinating. I want to quickly bring up back to my Bloomberg chart, and I want to go to this chart here, which might take a couple of moments to load up. My internet's very, very slow at the moment, unfortunately.
I think the storms that we've had through Melbourne and certainly out in the Bellarine have they've interrupted the internet. There's no question about that.
Yeah. So I'm looking at, this is a Bloomberg terminal, right? So what we've got here is what is the market telling me about 2021, right? So you've got here the US 10-year Treasury yield being manipulated. I think it's going to be more manipulated by the central bank, the Fed there. Have a look at the S&P, but I've specifically ring-fenced the cyclical sectors of the market and looked at them as a ratio against defensives, and you can see that snapback. So cyclical stocks and cyclical sectors of the markets have been really outperforming. You've seen copper moving up higher. You've seen crude moving up higher. We can go into the ISM manufacturing numbers and seeing that they're moving higher. These parts of the market are telling me that the world is going to heal in 2021. Have a look at, I've got this chart here, which is part of my Excel spreadsheet that I use for various things. But you can see this box here. And have a look at the growth rates that we're seeing this year averaging. So you can see obviously that they're obviously big declines coming through. That won't surprise anyone given what we've been seeing. But look at the rate on rate growth that we're going to be seeing next year. You go into Canada 4.9%, China 8%. I know we're looking at comparing this to a weak period, but we are going to see the world heal. And if you look at what the market's telling you, they are telling me that we are going to see better times ahead. Now, vaccines we've just seen Pfizer coming out with their numbers there, and they come out with phase 3 preliminary trials, which had an incredible 90% effective rate. And people are saying, we might get this winter of discontent. The COVID cases are flying at the moment. They're exponential, so the hospitalization rates. But you know what, Tyrone, we've seen what lockdowns look like. The concern in February, the concern in March was we didn't know what the circuit breaker was going to be. We didn't know how we were going to get out of this economic shock. This time around, whilst it's obviously a massive humanitarian issue at hand, we know what the outcome looks like. We've got a circuit breaker because we know a vaccine is going to be announced and rolled out probably mid next year. And so we've got the circuit breaker. The markets are therefore looking through what's going to be an economic hit because they're saying next year is going to be better. We've got this economic growth. The markets are telling you this situation. forward. And therefore, I think the market is now, if you look at the fixed income market there, Ty, I don't know how you guys look at that, but the bond market's breaking out. It's moving up. Yields are selling off and moving up quite aggressively and catching up with the message that we're seeing from that. And I think the equity market's feasting on that. So I want to go back to the charts here, because you've got this period where we don't have leadership. We've got the lame duck session, and therefore, we don't have anyone in the White House really controlling what needs to happen. Europe's already seeing lockdowns. My clients are talking to me and saying, why are the markets ignoring what's this huge, this horrific situation? And I'm saying, well, actually, do you know what? They're looking into 2021, saying they know a little bit more about what this happens. And I think the interesting one here is, if you have a look at, say, the Russell 2000, it's flying. The ASX 200, it's flying at the moment. The Nikkei absolutely going gangbusters that we've been seeing there. But yet the Nasdaq's been getting sold off because tech's coming off quite sharply. I mean, what have you been playing any equity markets? Is there any specifically that you like and want to talk to?
We do, and it's actually an interesting point, because actually Thomas and I were talking about this only today in terms of the Nasdaq. That didn't surprise him, because the Nasdaq, there's no question, it's benefited from, like it or lump it, it's benefited from this disaster that was 2020. The tech stocks in particular obviously are going to benefit from Zoom online. That took a significant hit when all of a sudden the vaccine could be potentially rolled out by the middle of next year. So it's no surprise really to see the Nasdaq come off a little bit. But in terms of equity, I'm probably a little bit surprised at how confident that the equity market is in this, because there's no question it's played a big role, especially in the Australian market. I've been quite surprised that the banks, in particular, the banking sector, has just gone absolutely mental over the last couple of days. And that does surprise me a little bit, because although I do agree with you that we've got a far better outlook, we've got that circuit breaker that was a potential vaccine, but I think from my personal opinion, there's still a lot of unknowns that we don't know about this virus and how the vaccine is going to be rolled out. Now, the problem is, could we have another strain breakout? The vaccine, is not going to cover. I don't know if we know enough about it yet to be as confident as the market is telling us. Like, from my standpoint.
Oh, wait, sorry. We've got a couple of people who've got sound issues. Is anyone else, or is this just one person, or can everyone else hear us okay at the moment? Can everyone hear Tyrone and me? Yep.
Great.
Everyone's okay. I think Noreen, I think it might be. Yeah, cool. Thanks, guys. Sorry, I just had a couple of people saying they lost sound.
Sometimes, just if you're on the web login especially, just log out and log in again, and quite often it fixes the sound issue for you. So just well, you probably can't hear me to do that anyway. But if anyone in the future, if you hear any sound issues, just logging in and logging out again and back in, it gets you back in and fixes the sound. So I think, although I am optimistic and I'm hoping that the recovery is there. Look, in terms of what you were saying about copper, Thomas especially is a very big advocate on copper. He basically brings up the copper chart every single week. It's one of the go-tos that we do look at, because it is a leading indicator, no question. It's been proven over time to be. And you're right that everything is starting to push higher. And from our experience, and I know it's pretty well known, the market does like to think 6 to 9 months ahead. So it's predicting mid to 2021 is when we're going to see things really start to pick up. But I guess my only reservation on that is, is the market being a little bit optimistic in the sense that it hasn't really factored in the damage that's actually been done to the economy worldwide, and also what is potentially going to happen in the next 3 to 4 months with shutdowns. Is the US going to shut down further? We don't really know. If that does, it's going to have I'm not sure. It's so sure the market's factored that in. And when we think about the levels that we're at and where the levels that the US are at, like, you look at the US levels and it's like the coronavirus never happened. And that probably does concern me a little bit, that we've had one of the worst years on probably record, certainly in recent time, and the market's nearly at the highest before the coronavirus even happened. So that probably just worries me. Is it being just a little bit too optimistic that we're, I just wonder whether we're factoring in the damage that's actually happened to the economy, and is the recovery going to be as strong? But that's just me being, taking that view that maybe easy does it. Let's just see how it plays out a little bit more than let's just not head to 7,500 on our index in the middle of 2021. I've heard a lot of people say 7,000, here we come, and I'm thinking, wow, we've still got a lot of damage that we have to actually pick up on, and these companies that have lost hundreds and hundreds of millions of dollars have to actually make that back. And that's got to be factored in at some point, I think.
Well, I think what's happening now is that the market is catching on to this, and they're looking through this period, whether that's right or whether that's wrong. They're looking into 2021 and saying we're going to see a cyclical recovery in earnings, and we're going to see a cyclical recovery in the economic situation, and we're going to look past this period of pain. If you look at the concern I have is what's happening in the bond market here. So the back end of the curve, the 10-year and 30-year Treasury is selling off quite aggressively. And what that means is that the tech trade has really underperformed. If you have a look at this chart here, which I've looked at the correlation of various markets, you can see that the trade really up until now has been, if you have a look at the this is the 10-year, the 5-year or 10-year Treasury, whichever one I've got to use the 5-year, but I've inflation adjusted it. So the real returns that you're getting in the Treasury market, and you can see as they've gone down, the dollar's really gone along for the ride. So you've seen this strong correlation between the sort of returns you're getting in the bond market, inflation adjusted relative to the dollar, and it's been very sensitive to that. But when both of those are going down, what you've seen is a very strong situation where the Nasdaq's been going up and gold's going up. It's been one trade, right? It's just been one trade. Real yields lower, the dollar down, gold prices up, the Nasdaq, kind of following. It's all really just been one situation. Those correlations are breaking down a little bit. But what we are seeing is real yields are starting to rise, and that's impacting the gold trade. Gold works. The way that I look at gold, and we'll touch on gold, I can see a couple of questions around gold. The way that I look at gold is that it is a yieldless asset, and whilst people use it as a fantastic portfolio hedge, it's correlations do break down, and people like to hold gold as a somewhat uncorrelated asset, or as the anti-bond effectively, because it has no yield. When the sort of inflation adjusted returns that you're getting in the bond market are becoming ever deeper negative, then gold becomes more attractive. And especially when you're getting a weaker dollar. So you get that sort of double kicker of a weaker dollar making gold priced in dollars obviously more attractive, and then you've got the relative real returns, gold versus Treasury market pushing up gold. Now, as real yields are moving up a little bit higher, you're seeing gold coming under a little pressure, and you're seeing the Nasdaq coming under pressure. What you're actually seeing in return is people are actually saying, well, if bond yields are moving up, curves are steepening, then you want to sort of go back into these areas of the markets that haven't really participated, which is why you're seeing this big rotation out of tech, which have done very well in a low bond environment, and moving into the areas which have been unloved, which is where we see this value area. So this is the US 2000, so the Russell 2000, which has a lot more value orientated stocks in there. And you can see that the trend here is much better, much stronger, that you're seeing playing through here. The ASX 200 hasn't taken part. So there's kind of like an almost fade America to an extent. And go into the areas into the parts of the market that haven't worked as well. You've obviously got a yield trade here in Australia that's been quite attractive as well. But you've seen this beautiful breakout in the ASX 200. It's damn expensive as an index to buy. But in Japan as well, I mean, look at that huge move that you've been seeing there. And dollar yen's been moving lower recently. But it hasn't impacted the Nikkei in any kind of capacity whatsoever. So that's been a really strong market. So what we're seeing is that move up in bond yields, which everyone's sort of selling bonds because they're getting excited about 2021, has seen people moving out of the tech trade, which we saw was highly correlated to the dollar and what was happening in the bond market, and then moving into other markets. So this is where we choose our weapon of choice when we're an index trader. For me, I like to do long short strategies and pairs trade, and in pushing the idea of being long the US 2000, short Nasdaq as a pairs trade, and I think that's one that you can look at. I think if you go into China as well, I think looks really interesting. You've seen that that move to the top end of the range. It looks like it wants to break out. If that breaks out, that's one for your for people out there who are breakout traders. Obviously, we'll see how this reacts on a close out there. If it comes back, retest the breakout zone, and we use that as support, that could be very, very powerful. So again, this is one that's very much on my high watch list. And it's one that I think if we get a break of that, that's one that people should be looking at. Let's go back into the FX markets, because we've got this set up now. We've talked about the election. We still don't know what's going to happen with Georgia, but ultimately the markets seem to believe that we're going to get this split Congress, which is the perfect storm. I want to go back into some of if we are going to get this cyclical recovery, then the currencies that will benefit for me as a tactical guy are going to be those that benefit from a reflation, a better environment, and that's going to be your Aussies, your Kiwis, your CADs, your Nockies, those kind of currencies as well. So I'm keen to pick your brain. We saw the RBNZ out today, and I just want to have a look at this breakout here because I think this looks really interesting. So I'll just quickly touch on this because we've got a lot of clients who are trading this reflation trade, this better trade in 21 through the Aussie dollar. But if you have a look at Aussie Kiwi at the moment, you can see we're just right into these lows. We're into this swing here. So we're into the sort of 40-day lows there. We're testing really good support. So what would you be doing, Tyrone, on this? I mean, personally, I'll be waiting out and waiting to see if we can get a close through there. I know a lot of swing traders will be looking to buy into that, but for me, I'd be waiting for a close through there, see how price reacts, and then jump on board. But I think this looks like a really interesting cross when you're playing two currencies which will benefit from a reflation trade. What would you be doing with this cross here?
Yeah, I totally agree in terms of waiting and seeing on this one. I think sometimes, especially in an environment that we're in currently, where there's still a little bit of uncertainty, but there's optimism. I think that waiting, and especially if you get the break and the retest, a lot of people are quite concerned that if they miss the break, it's all over. But the truth is, we've always found that the better trade, if you do miss the break, is actually the retest of that zone. So. And that's why what the markets are doing a little bit at the moment is actually kind of exciting me, because we're getting a lot of very key breakouts of some very key zones, and that's across the board. We've got indices doing it. We saw that on the S&P. We've seen it on the ASX 200. And a lot of people get a little bit frustrated if they miss that initial move. Oh, we've missed out. But the truth is that the real trade is actually when it comes back and retests that level from above or from below it. And that's what we call a role reversal. When that role reversal happens and support becomes resistance, or resistance becomes support, not only is that the more conservative trade in our experience, but it's the one that can be more relied on. And that's the one that you won't miss, because you're able to actually set your alerts for that and actually get a really, really good price point. Because we're very big believers in price action and let price action dictate the way. Support and resistance is extraordinarily important. There's no question about that. But we always advocate that you don't want to be the first person running the lines in a battleground. Better to let the soldiers go and fight the war, and then you come in when the rewards are there to be taken, if you like. And that's what we call the role reversal test. So I totally agree with you. If we get the break below there, even if you do miss that initial break, I think if it comes back and retests it from the bottom, and generally that coincides with a pretty good fib pullback, that's the real trade. And I think we're really fortunate that the market hasn't. What I was really fearing, Chris, was that the market was going to have a ridiculous move up or down after this election. I was really worried that we were going to have an extraordinary sell-off or a really big rise up, because quite often that really upsets the ebb and flow of markets. But what I think we've seen is a very steady acclimatization to what the result actually gave us. And what that's providing us is some really good opportunities that the market hasn't overreacted really in any significant way. And even if it has overshot the marks a little bit, that may come back and steady, especially over the next 60 to 90 days. While we're a bit of no man's land leadership-wise in the US, we're probably going to see a little bit of steadying action. That's going to give us the opportunity to re-enter these zones in the direction that they're going. And I think that's where the real opportunities lie, because I think then you can set up some big moves going into 2021.
Have a look at this Kiwi move, because I think today, obviously, the RBNZ came out. I'm not sure if you saw that, but whilst they've done a few bits and pieces, they've indicated that they're less inclined to go down the negative interest rate route. And if you look at the interest rate markets, they've priced out negative rates now, and the Kiwis really benefit. We've obviously seen that in Aussie Kiwi. But you can see here that we've got the breakout in the Kiwi. So the Kiwi for me is like one of the strongest currencies. I love buying strong and selling weak. It's a really simple place to start in FX trading, but it will serve you quite well. And the Kiwi is now looking pretty strong. It's a great way to play reflation. I like the idea that we've got the breakout, we've got price moving and holding this 5-day exponential moving average. When I see this kind of big impulsive moves, I like to see, you know, the buying stepping in. You might get it below there, but it will close back above that level. It tells me that there's a strong trend and the capital is flowing towards the Kiwi. So this looks really interesting to me right now. You know, we're looking at strong candle. I mean, if you how would you be playing this now? So daily, would you take the time frame down? I'm happy to control that.
Yeah.
What would you be doing? This obviously triggered now. Go on.
What I like about this trade, and we often speak about this, is we don't like price meandering at the resistance level in a channel and then having a candle breakout, because for us, we would much rather what's happened here, which is a significant amount of momentum building before it actually hit that resistance level. Like when we see a breakout, we like to see breakout with momentum, probably similar to what you've explained. So this has come from a pretty low point and really blasted up and broken the resistance good and proper. Now, yeah, straight away we can see we've got a series of higher highs and higher lows there on the daily. And if we go to a 4-hour, stuck to a 4-hour chart, you're probably going to see that a little bit more clearly. Like you can see a series of higher highs and higher lows. And even though the pullbacks are relatively shallow, they're sticking to that moving average that you just talked about. But I think what we like about this is it's hit this resistance with a pretty significant amount of force. And this is my point exactly. If you were a short-term trader and you were looking at this 4-hour and you missed that initial burst, you can see that price came back and actually tested it again and gave you an opportunity to get in. And generally, that's not much different on the bigger time frames as well. Now, of course, when we go to the daily chart, we're just stuck to the daily again. You know, you might think, well, if you're not in this trade, what are we going to do now? You know, what we also aren't big fans of is jumping on a moving train. We do like to wait for that pullback to give us an opportunity to get in at a better price. Now, generally speaking, it's rare that a big currency move will just continue long without a pullback at some point. And sometimes they do. Look, sometimes you don't get on, but that's just trading. But you know, for the most part, the more conservative trade here is for waiting for price now to come back and retest this level from above. And if we get that, come back to that blue line, which is around that sort of 67, high 67s, you know, that's going to be the trade for mine. I think if it pulls back to that, you know, we'd be looking for longs all day on that, because I think that really could. A lot of people say, well, why would you be waiting for the market to pull back? You know, isn't that a negative sign? Well, not really, because a healthy trend for mine is a 2 steps forward, 1 step back trend that, you know, moves 2 steps forward and comes 1 step back. That's what a healthy market is. A market that goes out of control long and doesn't come back generally falls just as quickly. But a long-term sustained move, like what could potentially be happening here, would see a pullback to this level and then a really good reload consolidation zone above what has already been a good form of resistance, which should now be a really strong level of support. So that's what excites me about a few of these moves. I think they're setting up for that, and I think we might see it.
I love this chart as well, because if you know, Aussies again, another one that you're playing that reflation against a Euro Aussie it's been trading this amazing range really for, you know, since May, and it's just been, it was incredibly frustrating. We were putting out to clients that this idea that it's broken out. I mean, you had a little bit of a move up and then bang, see ya, coming back down. And now we're down at the bottom of the range. We're looking a bit oversold. I mean, this is one for me which, you know, has been pretty predictable since May. This is right at the bottom end of the range. I think this is one that's either going to break down, and if it breaks down, it's going to be the start of a very powerful downtrend, in my opinion. Or this could be a fantastic place to buy if you like buying at the bottom end of the range. So this, to me, now is one where you can take the time frame into your 4 hours, see how price is reacting into that, and you know, this is trading right at the bottom end of the range now. Do we buy now as it's at the bottom of the range, or do we wait for the breakout down to the downside? You know, that's what I'm looking. So this is one that's very much on my high watch list, and this is one that I will be looking to trade. I love the fundamental story, as I think Euro Aussie goes lower fundamentally, and we can see the flow of capital is backing up my idea. But now we are again at the bottom end of that range, so it worries me about, just to see how price reacts into this low, and then trading that accordingly. What would you be doing here, Tyrone? I'm just cognizant of time. That's the only thing.
Yeah, this is a really interesting one, and I'll keep it fairly brief because for all of you who follow us, and I know a lot of you too, I've done this one to death. I absolutely love this pair.
Sorry.
It's been one of those ones where, like I've traded this one probably nearly more than any other for the last 5 months, because I think its range has been fantastic to go on. So I agree with you. For mine, I don't stop trading the range until price action tells me to. So yes, it is at the bottom of the range again, but I would still be playing the wait see, but taking the short term scalping approach on this one, and using the short term price action to dictate what it's going to do next. I agree with you that when it does eventually break, I think the downside is significant, if it does break to the low side, that is. But part of me, the selfish side of me, wants it to reload from here and start pushing up, because it has provided some really good scalping opportunities for quite some time now. And yeah, from a selfish standpoint, I actually don't want it to drop, although, even though it does look, notoriously weak, I do worry a little bit when it falls so sharply. Like previously, it's come down, found a reasonable level of support here, and sort of bounced up. The next few candles are going to be very, very interesting on this one, on the dailies especially. I think it's a little bit of a watch and see, but I still think there's some really good scalping opportunities, especially to the long side, until it does eventually break. I don't try to predict a channel break until it actually happens, and I just trade the short-term price action until it does. But this has been a great one. This has been really good this year.
Yeah, I just want to touch on gold, and what I want to do here is I think all these central banks are doing different things, but for me, there's only one central bank out there. The PBOC are pretty important, but the world is a price taker from the Federal Reserve. They control the markets. They can control currencies. Everyone else is just there. The RBA, the RBNZ, the Bank of Canada. They are there to limit the appeal of buying that currency. The Bank of Japan, the Swiss National Bank, they are there. All they do is try and keep in lockstep what the Fed are doing to limit the appeal of buying that currency. If the Fed want to weaken their currency, they can do so. I know everyone says they're out of power, but I think if they want to, bring down the dollar, they can do, and they do that by bringing down real rates. Why do they want to bring down the dollar? Well, they've got this average inflation target. They want inflation to move above 2% and average to do so for a period of time. I think in April we are going to see inflation move above their target, and the main reason being is because of base effects. Inflation in April was incredibly low, but will it sustain that level? Now, I think if they're to be believed to achieve their mandate, their new mandate, they need a weaker dollar. And they need real rates to go much lower. So inflation-adjusted treasuries need to go lower. The way they do that is by doing QE around sort of 10-year treasuries. So they're doing bond buying in there to keep bonds from not moving up too much higher. If we do see a cyclical recovery in 2021, then inflation expectations will move higher, and that means real yields will go lower. The dollar will go down that. So why do they need a weaker dollar? Well, if you actually look at this chart here, what I've got is the trade-weighted US dollar, which is the blue line here. And I've actually inverted it, so you can see here that the dollar's actually going down rather than up. I've just tried to make the relationship here. And I've looked at inflation surprises, so this is an indicator that Citigroup have. And you can see that there is a relationship here. So a weaker dollar has married with US having better inflation surprises. The other one that you want to have a look at is, and I'll lead this through into gold in 2 seconds, because I think we'll close on that and then maybe open it up to a couple of questions if we've got time. If you have a look at this chart here, we can see again, you've got the trade weighted dollar, which is the red line, and I've again flipped that upside down to show the relationship, and world trade volumes. And again, you can see that as the dollar's been weakening, world trade volumes have been pushing up. I can have a look at, I've got other charts which show that, a weaker dollar will impact Chinese imports, which have a positive impact on inflation as well. So if the Fed want to actually really boost animal spirits and really go after inflation and achieve their mandate and gain credibility from the market, they can do so. They need to anchor long end yields through QE. They need to make people want to spend money, which could happen in 2021. The consumer could come back. and that will mean that real yields will go lower. We've already seen from that chart earlier that real yields, inflation-adjusted Treasury yields, are good for gold. So I think when the Fed meeting comes up in December, there's a real opportunity for the Fed to show the world that they mean business. And there's not many other things that central banks can do. They have to take the price from the Fed. So we're going to gold, because if the dollar is going to fall, and again, we'll come back to my dollar index chart, because that will, that's my theory. Whether it plays out, I don't know, but it will be seen on this chart here. And as price moves into that, then I'm going to increase my conviction that the Fed are seeing this as real rates go lower. If they go lower, then I'm going to start looking at gold in a much more positive light. For me, I'm neutral on gold right now as a trade, as a medium-term trade, as a short-term trade. We've seen the break through this downtrend. It was a failed break. We got smacked back down as bond yields moved higher. And we're in this sort of no man's land at the moment. I'm pretty neutral on gold, but I think if the Fed want to bring down real yields, if they want to smash the dollar, which, as we see, has a positive impact on inflation expectations and inflation, and will help them with their mandate, then gold's going to benefit significantly. So for me, tactically, Tyrone, the time to buy gold is not now, but when we start to see those dynamics playing through, and perhaps when we go into that Fed meeting in December. I've got the daily chart here, but for me, it's no trade. Wait till price starts moving a little bit higher. Wait till the buyers start coming back in. What would you be doing on gold?
Yeah, from a standpoint of that sort of medium to longer term view, 100% agree. We learned very early on that you shouldn't back against the Fed, and I 100% agree with you that the Fed generally gets what they want. They'll make it happen one way or the other. So yeah, I totally agree that if their wish is for a weaker dollar, they will get that one way or the other. And gold will have that will be the beneficiary, or the greatest beneficiary of that. From a short-term standpoint, though, I think gold still provides a reasonable opportunity to actually trade that range that it's got itself in, because I agree. I think it is from a neutral midterm standpoint, it probably is neutral until it gets a catalyst for a big move, either long or short, depending on the implications. I think it's providing us some good opportunities to actually trade this range. And for all of you who do follow price action, I think, look, at the start of the year, and I'll probably harp back onto it a little bit. At the start of this year, gold and oil were probably some of the best technical trade setups from a short-term standpoint that you could have traded. There was a technical analysis, pattern over pattern over pattern. And if they were the only things that you were trading prior to the COVID outbreak, you were doing very, very well. We talked about it to death every single week. It was the first thing we talked about, because they were providing such good trading opportunities. And I think now that gold's found itself in this ranging, and I know it had a bit of a move the other day, it had that bit of a price shock, but I think and you probably agree, gold has turned into a very tradable commodity now. Like previously, in years gone by, it was treated as an absolute safe haven and a hedge, and it was a fantastic portfolio hedge. But in recent time, we've found that it's become a very technical trade, even from a short-term standpoint. And I think the technicals hold up really, really well when you are actually trading on the smaller time frames. And by smaller, I'm talking about 1 hour, 4 hour, and using daily as a bit of a bias. So I think I agree with you longer term that it's probably right as we speak. I think it's in that neutral zone, and I haven't really got a directional bias for the longer standpoint. But I think in the shorter time frame, I think it's providing traders a really good opportunity to take advantage of price action and trade the key levels. Yeah, and when I say key levels, the 1800, the 1900, when you trade those correctly and you use small time frame. Higher highs and higher lows, or lower highs and lower lows. And I'm talking about pure, oh, there goes Siri. I'm talking about pure price action here. I think it provides really good opportunities for traders. So certainly not to be ignored, even though we've got a longer term viewpoint on it, and we're waiting and seeing for the Fed to really dictate what happens to it from December. I don't think it means it's a no-go zone for short-term traders. I think it could provide really a scalp. I think scalp is the word here. We don't use it often, but I think the market is in a really scalping environment where you've got some really good opportunities if you do it correctly at the right levels to capitalize on what is essentially pretty good technical moves on those 1 hour, 4 hour, and even daily time frames.
Okay, I like the idea. You've seen this. I mean, obviously, it's not difficult to get a reversal through this tiny little doji here, but you've got the big reversal playing through, and we've seen the market respect and not follow through with a lower low. And I think that's quite interesting there, that it's been negated. This bearish outside day has been negated there. So that looks quite bullish. And I think that if it does go this bottom here, I think that's going to be quite powerful. But it seems that the gold bulls are holding on. We're going to go to a couple of questions now, just to finish off, and obviously cognizant that we run over a little bit now. There will be a recording there, so anyone who registered for the webinar will get a recording. I want to go to I want to start with let me just try and bring this up. Dollar yen. So we'll just go through these really quickly. Yeah, dollar yen's been working. We've seen that back up in the yield curve. Interest rate expectations have moved up a little bit in the US because everyone's getting excited about 21, as I keep saying. Seeing these series of lower lows, lower highs getting taken out, or lower lows there coming out, or high lows coming out. Do you think, Tyro, how would you be playing this right now? Would you, just really quickly, would you be looking to take it into the top end of this range, or would you, would we be fading this? Are you seeing anything from the price action that you favour right now?
Yeah, up until 3 days ago, I was very, very bearish this pair, and it broke a significant zone for mine. And to be truthful, I thought it was heading down to 101.50 if it had kept going. Now that it's done this, you're right. I think the top end is its likely target. I think we're probably looking for that bit of a pullback now. I think it needs to probably steady up a little bit, but if it does that and consolidates, a little bit lower than it is, I think that sort of high 106 is probably a pretty reasonable target for it. Maybe the 107 is a very, very key zone for this one. So yeah, it's looking long, and I think it's probably a really good lesson to all of the traders out there to be part of being a good trader is actually being able to change your direction when the market dictates you do. So you can go from being very short bias. I'm telling you, 3 days ago, I thought this was going to 101.50, and I was actually preempting that if it came back and retested that zone, I was going to be short all day on this. But my market sentiment has changed completely just on price action. Now, price action has done something that certainly doesn't warrant that thought process anymore. And I think it's really important that traders can actually adapt to what the market price action does tell you, because if you're stubborn about it and try to fight what price action is telling you, 9 times out of 10 you're going to get burnt. So you've really got to be market adaptive in your views, especially if you're short term. Okay, and yeah, I totally agree. Now that this has done this really, really big bullish reversal from what was essentially a pretty key break, a little bit of a retest now of these, even your trend line there that you've drawn, a retest even to that would signify a pretty strong move up, I would have thought, and I think the 107 is probably the logical target.
Yeah, I mean, if you have a look at the weekly on dollar yen, I mean, jeepers, every time we get below the sort of 104 level, then something magical or mysteriously comes in and starts buying. But yeah, we didn't quite get a lower low there, but we've had this huge reversal above these highs, and the market's tried to sell off, and it's just finding buyers. These wicks are not overly huge, but they are, they're showing that there's good buying support coming through. Obviously, if you take the time frame down, you get a breakthrough this consolidation. That's going to be quite powerful as well. But it's not what this dollar yen's doesn't, apart from this move here, generally doesn't have that high beta, high explosive move. It's more of a grind. Obviously that has big considerations for your position sizing. We're going to go. I don't know if I can get cotton up. I don't know if I've got that in my thing. I might have to give that one a miss for the moment. Sorry, we can come back on that. Maybe my things aren't showing for some reason on my MT4 at the moment. I need to get that fixed up. But what we do have is, I want to have a look at, let's have a look at the pound, because that's a really key one, and we're going to euro pound in a moment. Brexit's a really key one, right? Because you've got the dollar weakening a little bit here, but you've also got a situation where, I don't know, any day we could get a Brexit deal. I think we are going to get a Brexit deal. I think that makes absolutely no sense whatsoever that we don't get a Brexit deal. You've got this wave of COVID that's ramping across the UK at the moment. To go and shoot themselves in the foot would be ridiculous. Scotland, Craig, reach out to me afterwards, mate. We'll sort out a chart of cotton, or reach out to Tyrone and we can give you some thoughts on that. I'm just getting a blank screen there for some reason. But it makes no sense to me that we don't get a deal. It makes absolutely no sense. There's the Scottish issue with there's a rising issue about referendum. Ireland's a problem there in terms of the peace situation. There's there's a whole heap of reasons why they just don't need a week. These headwinds, they are making a deal would just be so good. Of course, Biden, if they want a free trade agreement with the US, then they really can't go against Ireland. So I think the pound's an interesting one. We could see a gapping risk if a deal's been made over the weekend. It's trending now. I really like the pound at the moment. I think the pound's a really good currency to be long at the moment. I like where the flow of capital is. I think we probably go up into these 134, 135. What's your views there, tactically or from a price action perspective there, Tyrone?
Yeah, I think it really wants a 134.50 to 135 in my opinion. I think it probably, Brexit deal or not, I think it could reach it before it even gets an outcome. I know what you're saying. It could happen very, very quickly, but price action tells you that it wants to go up. You can see the rejections. You can see even 6 or 7 candles ago, like that hammer candle there after that little bit of a pullback at a point of support really shot the market up. And I think it was a really good trading opportunity for the shorter term traders as well. It does look long. It's been strong. And, it really wants to, like that 40-day moving average that you've got at the 40-day high, it looks like it really it wants to break above it, doesn't it? And you can see. I think it's got 134.80 in its sights. I think it really does, and I'm not so sure it's going to be before it gets there.
Yeah. Okay. Well, I think that's the risk. I mean, if people are just do consider if you are running cable exposures or pound exposures that and into the weekend, that if we do get an announcement, and that's generally when they tend to play these things, that there is going to be gapping risk, positive or negative. But if they're going to make an announcement of a deal, it's probably going to be positive. Therefore, so that's definitely something to consider. And also you've got the euro pound. I mean, obviously you've got issues playing through Europe at the moment, and similar situations playing there. But also from a funding perspective, you've got deeply negative real rates in Europe, and also in the pound in the UK. But if you have a look at the flow of capital here, we're coming into this very strong level of support. 88.67 or so. Again, this is kind of like that Euro Aussie trade, isn't it? We're coming into that low end of the range, which has been been in play for such a long period of time. And obviously when you're looking at these patterns and various things, the longer the duration, the more power that those breaks can have. What would you, again is this? Would you be trading this the same as Euro Aussie? I mean, this is one. Would you be looking to trade the support here, or what would you be doing?
Yeah, with the support on this one, again, I don't totally trust the support this time, only because there's so much to play out with these two currencies. I still take the short approach on this one. I do like that the support is very, very strong. It's been there for a very long time. And on the smaller time frames, any higher high, higher low sequence on a smaller time frame, an hour or a 4 hour, would give me the long bias. And I think what I like about this one is its targets are very, very clear. So if it does bounce off this support again, you're not going to the very top of the range. I think you're better off playing the smaller middle of that range move, and I think you're going to get some really good outcomes from that. So the minute price action changes, it's just going to simply gravitate to those key zones, and around that sort of 90. 90 is a bit of a given for this. Like, it's a very, very important zone for it. A round number, very, very psychological level to play. So any time frame that's giving me anything above a 15-minute chart, that is giving me a higher high, higher low sequence on this level of support, is going to get me going long to the 90. I think it's going to give some good trading opportunities, but like a lot of the others that we've talked about today, they're setting up for some very serious breaks if they happen. And I think what that's going to provide us, especially early into 21, is a good worldwide trending market around the world. And I think we're all longing for that. I mean, the sideways markets are great, but there's nothing like trading a big long trending market that you can trade in one direction on the pullbacks. I think it makes trading very, very easy. Like, I know trend is your friend is a very common analogy, but there's no truer word spoken. Sideways markets are great, but there's nothing like a trending market to be part of. That's for sure.
Yeah, no, I don't like buying. I don't like buying this sport, to be honest. I would actually just have this on my watch list, and if price breaks through, I'm going to get an alert and see how price, then obviously take the time frame down and see how price reacts, because fundamentally I think there's reasons to like the pound. You know, they've got deeply negative real rates, which is a negative for the pound, but they're becoming less negative, and they're becoming less negative at a rate of knots. I don't think the Bank of England are going to go to negative rates. I think, you know, they've done the QE, they've got that out of the system. COVID's an issue, but it is in Europe, and if they come out with this free trade agreement, then that's going to cause, you know, pound shorts to cover, and that's why I don't like doing it. So fundamentally, I like the pound. But I can't be selling it now. You know, if I was going to sell it now, it would be like really small size, and then add on, you know, as and when it breaks and closes through these levels. And if the trade's working, then I'll do more of what's working in that situation.
Similar to what we talked about earlier, yeah, but waiting for the confirmation break, and then especially if it comes back and retests, you're going to get your reload zones. There's plenty of time because the downside is significant, and I think that's probably the point. Like, you don't have to be the first in. If it does go short and breaks through, there's going to be many hundreds of pips there for the taking. So there's going to be plenty of opportunities to get back into it.
Yeah, we'll cover one more market. I'm just going to say that in terms of the recording of this, Tyrone, you're going to be putting this on your site. I think we'll probably be putting it on our YouTube channel as well.
It'll be in YouTube tomorrow morning. It'll be on the Pepperstone YouTube channel tomorrow morning, and it's also going to be in our Discord channel. So yeah, there's plenty of opportunities. Anyone who's registered will get a copy anyway. But for all of those who have missed it, it'll be in the Pepperstone YouTube channel tomorrow morning.
Cool stuff. We're just going to quickly cover this one up and then wrap it up. Crude, absolutely key. I mean, what the story that I'm hearing from the crude here, this is about near-term demand. I can look across the crude futures curve at 5th month, 6th month, and it's all moving now. It's telling me that there's a story about the global demand. I know there's a lot of people who are watching this going, Chris, you just don't get it. We're not going to see those levels of euphoria in 2021. Yeah, maybe that's right, but I'm just looking at what the market's telling me across markets, across asset classes, within sectors. It's telling me that they're in for better times. And you know, the crude market's now started working up. They are expecting demand. I know OPEC are in there as well, but look, you know, we've broken through these highs here. You know, that's pretty bullish. Obviously, the big level that we're looking at in our crude price is about 43.50. That's the level that we're coming into. That obviously that holds such significant impact for global markets. If crude markets going up, we're going to see inflation expectations moving up. Again, that could be very good for gold, because if inflation expectations are moving up, then that's going to bring down real yields. Yeah, all these factors are great. It's great for equities. Energy equities look really great at the moment. Big level coming into the crude market there. What do you think?
Yeah, I think it's an absolutely key level. Probably one of the most important levels on all of the things that we've looked at today. Actually,
yeah.
It is a major driver for many other trading instruments, really. So I agree with you. I think that it's really just it's a watch and see. I think if you're going to trade this one, you'd be brave to go short on it until it reaches that level. I just can't see it pulling up until it at least reaches that high. Yeah, probably look for the pullbacks and trade into that level. But again, I wouldn't be going long on it either. I think it needs to prove itself. If it gets above that level and closes significantly with a significant candle above it, I think we can trust it a little bit more. But again, I think it has to prove itself. It's not one of those ones that I would preempt it's just going to go long because the outlook is so rosy. But I agree. It's very, very strong at the moment, and I think it's going to take a lot of holding back. It's a pretty easy trade, I would have thought, to get it to that level.
Well, I just you see price now holding this 5-day exponential. I just wonder if that's going to start a more impulsive trend higher. But do watch price around there. If you do see price rolling over, you know, that could be a very short-term trade for obviously a scalp or so. But I would. A break of that level could be very powerful as well. Just watching, how price reacts on any kind of selling into that 5-day exponential. If you do trade off, daily charts, where a lot of people will be trading off lower time frame or different time frames than that. But that's, I think great for the big picture. So big levels coming in there. Can't emphasize that enough. All right, so we'll wrap it up. Sorry, go on. Sorry.
We will wrap it up. Thank you so much, Chris, for joining us today, and really giving us a different insight to what we're normally used to on our fortnightly webinars. It's really, really good to get an insight from a fundamental standpoint, and also looking at a lot of charts that we don't cover. So thank you very, very much for your insights. I hope everybody's enjoyed that. Like I said, the replays will be up, so don't worry about it. If you missed anything or if you want a recap, you'll definitely get a replay. And our next webinar, the next Pepperstone webinar, is on the 25th of November. So look out for that invite. It should be with you usually a week leading into it. Please fire off any questions. I know we had a lot of questions. If you've missed anything, fire them off to us. We'll be happy to get to them in the next webinar. But look, thanks all of you for joining us. We hope you found it very, very useful. And thanks again, Chris, for making this webinar a very, very good insight into what the post-election world looks like.
Yeah, no, exactly. I think, it's going to be a really interesting time in markets. Do we get higher volatility going into the end of the year with all the concerns we've got, Trump not stepping down, COVID, various other factors, or do we just keep looking through that and we get a situation where, let's not forget, Tyrone, that a lot of the active fund managers out there, if the markets keep going up and up, they have to be involved. There's a lot of cash on the sidelines. And the old FOMO trade will be the reason where we keep pushing up in risk, and oil's going to go up and all these other factors as well. So don't discount that the markets can go up just because they have to be outperforming. They've got to be invested. If the market goes up and you're out and you're active and you're underperforming the benchmark, you're going to get nailed and you're not going to make any money and you're not going to get paid by your clients, more importantly. So that's really cool. I want to also just quickly say, if anyone wants to get my daily research, the daily fix, just reach out. You can see me on Twitter, and also follow our Telegram as well for various insights and articles and various back factors as well. So that's my little plug.
Yeah, no, we do that every week. So I'm glad you brought that up. But obviously, the Telegram is really, really important. The Pepperstone Telegram really brings out the news that you may miss otherwise. And you can set it to give you alerts. So you can even get the alerts when news comes out. They are very, very proficient at updating all the most recent news. So it's really something you need to have in the back end, because it is sometimes vitally important to get that news in a timely manner, especially when you are trading without looking at the fundamentals all the time. So, okay, well, that's us. Thank you very, very much, everyone, and have a great night, and we will talk to you very soon.
Thanks, guys. Take care.